Well, hello, everyone. Thanks for sticking with us late in the day. Probably standing between you and happy hour, so we'll try to keep the energy level high up here. I'm Martina Welkhoff, one of the founding partners of WXR, where we're investing in women-led AR/VR companies, and I'm joined up here by a fantastic panel of investors. Really excited to hear from. Just before we get started, I want to do a quick poll, and I can kind of see you all out there with the lights. Can I get a show of hands? Who are the entrepreneurs in the crowd? Who is working on a startup right now? All right, and out of you out there, who's raising money? All right, great. So we'll have some good pointers for you today. Fantastic. Well, I'm going to let the panelists introduce themselves, and I would love to hear from each of you a little bit more about your fund and your thesis, as well as one or two investments you're really excited about, so that we can have some context for the rest of our discussion here. So let's start off with you.
Hi, my name is Ajay Singh. I'm part of Samsung Next, the early stage investments fund, focusing on all the emerging technologies. I do investments in artificial intelligence, machine learning, as well as AR and VR. Some of the stuff that we have worked on, actually some of the co-investments that we've made with other panelists are on foundational tech companies like Ajay with RRE and Baobab Studios with Comcast. Our thesis is mostly on the foundational tech side, so we believe that we are in the early stages of investments in AR and VR stage. So in this space, we care about the technology the most, and the teams that can actually be resilient enough for staying and surviving this wave one of AR and VR. So that's us.
Hi, everyone. I'm Alice Lloyd George from RRE Ventures in New York City. We are a seed and Series A fund, been around for about 22, 23 years. Actually, I think we just announced this week, I can say that, we've closed our Fund 7 for $260 million. So excited to invest in a lot of the companies here. So we're already investing out of that fund. But the fund was founded by Jim Robinson, who is CEO of Amex for 16 years. So father, son's business school partner, the three of them. And we're a lean team, really a 6-person investment team, and pretty broad. We do enterprise, consumer, we do hardware, software. We don't really do VR or AR hardware. I should classify before I speak to anyone in the audience about that. But in terms of this area and what I do, I've helped build our emerging technologies thesis over the last few years. So that does include some blockchain and crypto since 2013, since we have fintech, fin services DNA, but also includes machine learning, computer vision, satellites. We are one of the funds known for doing space tech, and then in the last 2-3 years, VR and AR. So Ajay mentioned our co-investment Ajay, which is volumetric capture and holograms. We've also we just announced we led the Series A of the Wave VR for any VR users out there, so we love them. And then a few other smaller AR investments, not all announced, one in storytelling and sort of experimenting in that area, and another in a military AR application. And so, yeah, we're excited about these areas and to see where they go.
Excellent. Hey, everyone. I'm Rich Tapalaga. I'm a director at Qualcomm Ventures. We're the corporate venture arm of Qualcomm. The fund's been around for around 18 years now. Largely, you can view us as an ecosystem enabler. And traditionally, we've focused around supporting the wireless and mobile ecosystems, and our focus today largely resides around what we call the smartphone dividend. So basically all the components, technologies, display, compute, sensors, GPU, everything that went into cost reducing and size reducing a smartphone. We're looking to enable those technologies into other new verticals. So big focus on frontier technologies, a lot of focus on the enabling technology side. We focus a lot on AI, machine learning, computer vision, and then basically all the verticals where you can apply those. So drones, robotics, and then AR and VR, which is the area that I spend most of my time on. Some of the companies that we've invested in, I think we have 8 investments in AR and VR. in different kind of forms and fashions as well, most notably Magic Leap, which is one company I'm super excited about. They're a full stack developer. They'll be bringing out a wearable device to the masses, hopefully very shortly. I think it's really interesting, them being full stack and actually giving creators and developers an interesting platform to develop on. Another company which is not disclosed yet, but in the location-based space, I think is also very interesting because it drives mass adoption. It allows people who don't have access to these great VR devices in their home or in their offices like we do, to basically go through these experiences and really start driving it from a mass adoption perspective. So really excited about that one, hopefully announcing in the next week or two. We're a global firm, so offices in China, India, Israel, Brazil, and Korea, and we have AR and VR investments in most of those regions as well.
Hi, Michael Yang, Managing Director with Comcast Ventures. This is my 10th year with the fund. We're a 20-year-old corporate venture fund, multi-stage investor. For Comcast Ventures, I lead our investments in VR, AR, in Internet of Things, which includes wearables, kind of the smart home revolution, drones, as well as autonomous vehicles. And then I also spend a lot of time in the broader healthcare space, healthcare services, healthcare IT, and digital health. As it pertains to VR, AR, have the honor and the privilege of serving on the boards of Baobab Studios, Felix and Paul Studios, and Spaces in the LBVR space. And then we're also investors in Kite and Lightning, in Meta, and in NextVR. So happy to be here, and thanks for having us.
Awesome, thank you. All right, well, let's dive right in. So we've already heard some fantastic companies, Baobab, 8i, Magic Leap, Meta, all very inspiring to the broader community. And I'm curious, what was it about those companies? And I don't know if you all heard their first pitches necessarily, but as you were discussing internally, as you were getting excited about these investments, what was it that really made those companies stand out, and how might we be able to translate that to companies out here in the audience that are working on raising, kind of those key things you're looking for when you first see a pitch? Anyone can jump in.
Go ahead.
Sure. So I guess I can start off with Magic Leap. One of the most interesting things when I first met Magic Leap was basically, from the outset, it looks like they were about to boil the ocean, right? I mean, they were doing everything from optics to software to hardware. But the more you dove into it, the more you understood what, having that full stack approach really meant. And when you're taking a novel and new technology to market, you really have to package something that can be readily accessible, so easily accessible to a customer, and the overall vision on how to drive that going forward. It's a lot more complicated than it seems, because you're basically incubating 5 or 6 distinct companies within one. But the interesting part is that you're able to move each of those technologies, whether it's display, the hardware, the UI, the software, all at the same rate, so the end experience is very tightly integrated. And I think that possibly guys like Oculus or Vive, deliver that in VR, and we were looking to do something similar in AR, where you can actually go out to the masses and give them a full product just to work on. And the overall vision on where the company can go is just really intriguing.
Mm-hmm. Definitely.
I'll back Rich up, similar philosophy, which is, I think in the early days of this market, you had to be full stack, right? While VCs prefer kind of high gross margin software-based businesses, that's really challenging to kind of find in this market at this point in time. So if you got in and were writing checks in 2015, 2016, 2014, inevitably you had hardware, software, and maybe a service or system component to it. And I think you needed to do a full stack in order to learn what the market was going to demand and where to kind of evolve the product set. I would say probably more unique for us relative to some of the other investors here is we have some content studios, which you might wonder, like, hey, how does that fit? In fact, those content studios really are full stack developers as well. They do, for us, Felix and Paul and NextVR do their own cameras, right? So you have a hardware and optical team, a lens team, as well as a creative team. So for us, back to your original question, we always, because we're primarily Series A investors in this space, focused on three skill sets or three attributes of talent on the founding team. One was a business lead, one was a creative lead, and one was a technical lead. And we would not invest in a company unless you had all three of that magic kind of triangle, because tech by itself without the other two didn't work, since some of them were more on the content creation side. If it was only creative but without tech or without business, it was going to work the whole 9 yards. So that we were very principled about our team selections, when we got into this.
I can jump in from the early stage standpoint. As I mentioned, we are in the early innings for both AR and VR, and we've first invested in AI. Our thinking was that for doing any kind of technology, there's always multiple ways of doing it. But the teams that we felt comfortable were the ones that always had a very first principles approach in terms of trying to solve a problem with that technology. And once you start going down the path, you actually get more comfortable with some of the founders who have that resilience of staying alive, because this is early innings, as I mentioned. So not only just thinking about like how cool the tech is, that a demo looks awesome, and all the shiny stuff, but also like, can they stay alive? Because most of it is, running a company is not easy, as most of you already know, and much of it is going to be how to maneuver around with this time. Like I think next few years are going to be telltale in terms of how much AR and VR is going to show as attraction. So we believed that with any of the companies that we invested with, the founders had that passion and that resilience and that first principles approach in terms of solving a problem.
Mm-hmm. I'll just jump on that, and I mentioned two of our companies, one being the Wave VR, who I think some of the co-investors are here, and incredibly scrappy. They know how to build, really lean, and super passionate, again, about what they're doing. I mean, early days, they were sleeping in the server room, and they live and breathe the product. It's, first use case is really music, and it's very music-oriented. Everyone on the team plays music or makes music and is also a technologist. So to your point about being, just compounding that talent at early stage, we like to see that, especially in a company like that, which is a pure VR play. The other one, which we mentioned, being 8i, very specific thesis there, which is, I'm quite openly opinionated about this, never been a fan of 360 VR. And so, 8i being the sort of antithesis of that, which is volumetric. And we all know we're going to need to digitize real-world assets and put them into an AR, VR world. So volumetric capture and bringing real-world assets into VR, AR, and being platform agnostic, right? Holograms work on VR, they work on AR, they work on mobile. We also like that. And we also think humans are the hardest thing to do and probably one of the most critical. So that was sort of the thinking there.
Mm-hmm. Yeah, definitely. So team, it sounds like one of the resounding themes here is team, especially early stage, and especially in such an early market where we all need to be resilient and quite creative in solving the challenges we have at this stage. What about traction? How important is traction in your decision to invest? And if it is a factor you're really thinking about, what sorts of traction are you looking for? And is that different in AR, VR than other spaces you're evaluating?
I think it's so early that probably we don't pay any attention to any of the traction. Like I remember the early stages, people used to come up with hundreds of thousands of users, concurrent users, and all that. I think we're talking at a stall base that is like meager at this stage. So I think those traditional KPIs for defining traction are meaningless at this point. I think what you might want to go down the path is how the company is thinking about evolution of the product and evolution of technology. And those are the things that we very closely monitor when we start the investment process until the point when we start putting that in the portfolio and trying to monitor them very closely. Like, what was the original thesis? What was the thinking that when we invested in? And along the way, how the company and the team has actually performed along those KPIs.
Yeah, I'd like to maybe, expand on that a little bit as well. I mean, of course, I think we're all tech-heavy investors. The one thing I do like to see on traction, especially when I'm, talking to some of the early-stage companies, is unique KPIs. So, I mean, we all get kind of confounded by, daily active users, monthly active users, whatever these generic kind of terms are. But every business kind of has a couple of key key metrics that they should be tracking that should be ultimately unique to the business model that they're trying to bring forth. And I think that that's kind of where you start separating technology and tech teams from guys who are actually building businesses, is that they understand what they need to focus on, what KPIs they need to push, how to track a user, and how does that kind of work forward toward proving out their business model? How does it work toward their economics? Do they understand their position in the value chain? And are they building something more than technology? Because there's tons of great technology, but not everything kind of evolves into a large-scale business. It's really having that mix of really bright tech guys, but also guys who know how to look at a market and understand how they fit. And like I said, I think there's, the KPIs, I don't like general KPIs. I like someone who has something very unique that only really their platform is uniquely positioned to take advantage of, and basically how they grow that, because that ultimately what evolves the economics of their business.
So that's really interesting. I was talking to another investor earlier today about this, tracking various milestones and mapping that to how the market and products are evolving. And I would love to hear from you when you're evaluating that, when you're looking as kind of zooming out and looking at how these companies and founders are evolving. How do you balance adapting and learning and growing versus losing focus, or sort of, there's kind of a tricky balance there, and but there's a lot of risk in pivots. There's also potentially a lot of reward if you pivot at the right time. But when you as an investors are evaluating an entrepreneur's ability to adapt and grow, kind of what balance do you look for, and what are some maybe red flags that you see?
I'll start. So I'm hesitant whenever anyone wants to pitch me a platform, okay? Because there are truly very few platforms in the world of tech. So I think shorthand in VR, AR, when someone says platform, it means I have a horizontal piece of technology that I have not figured out product market fit on a vertical basis. I haven't crossed the chasm. I have a bunch of hypotheses on 4 or 5 different markets that my tech could be used for, but if you fund me, then I will use that capital to figure it out, right? So then that's a debate. Like, what's our risk appetite up here to want to fund that exploration, or what's our expectation that you, the founder, will have done that journey work before you come in to us? I think the other thing is it's okay if you started in a vertical or a market, you got reasonable traction, but you actually said, you know what, I'm not going forward, and I'm pulling back and going somewhere else. So I give mad props, and I don't know if he's going to appreciate this or not, to Derek Belch at Striver, right? When a lot of us would have first met him, it was a sports training thing. We're looking at Stanford college football videos and training thing. That's interesting. He even expanded beyond that into fan engagement and brand and advertising. But ultimately, he understood, like, that's a finite market. That's not a venture backable market. So I have to back out of that and go into a different market, which is more on the enterprise side and HR and all that. Full disclosure, we're not an investor in that company, but that is a successful pivot in my opinion. And he is very kind of very open about that. So, if he was just like, hey, I'm interested in training, I don't know if it's sports or this or this or that, that doesn't really give us a lot to work on when we're up here, because then we have to do that market research to kind of figure out where that dog might hunt.
It's a great example.
I was just thinking, I think early in kind of where we are, and in terms of where entrepreneurs try and speak the language of VCs, which I don't always recommend, but some companies have sort of split into, well, this is the tech part of our company and this is the content part in order to get funded, or we'll morph their businesses while they're trying to fundraise. And I think everyone sort of sees through that, and it's better to just stick to listening to the market as early as it is. And I respect pivots where it's actually, okay, this is early customer, but it's not a strong customer, so we're going to look at this vertical instead. And that kind of pivot to me makes sense, and we're happy to support that. And I think that, so I think that's the nature. I mean, we don't really know what the form factor is going to be, even with AR right now. So having that adaptability built in so that you can move on to another platform of the few platforms when we get there is really important, right? So being able to navigate across those and say, I'm not necessarily tied to this HMD, I'm not necessarily tied to smartphone, If this is a stepping stone, I'll be ready for the full market when it arrives.
Yeah, I think the the corollary to that is also chasing revenue. I mean, of course, everyone here, you have a finite team, a finite budget. The one thing I always ask when people show me their customer list is why those customers. Are you chasing them or are they chasing you? Are you proving out their business model or are you proving out your own? And I think that's sometimes where a strong entrepreneur comes in, and if there needs to be a pivot, he's given you the details onto why, as opposed to there being kind of dragged in that direction. And I think that defines some success to some degree.
So really understanding why, what's driving it. Yeah.
I agree to that quite a lot, actually. We see that beyond even AR and VR, there are many examples that you'll find where the most successful pivots are actually where somebody is actually pulling you into that direction, and mostly it's the customers. And those customers are taking you there because they find the interesting use case that you did not even think of that. And I also agree with Michael's point on platform is probably the most misused word from startup standpoint. And I think VCs love platforms, but there are very, very few successful platforms from a traditional platform definition. So I would highly encourage people to actually figure out what the product market fit is. And if that requires you to pivot, pivot is fine. I think the investors are there to support you in the directions that mostly make sense for you.
So that's a great segue, because I was going to shift gears into, we've been talking about how we all evaluate companies, but I would love to hear your advice on what entrepreneurs should be thinking about in choosing the right investors to work with. And how do you as great investors add value beyond capital, and what are some of the things entrepreneurs should look for when they are looking for the right investment partners?
I would say if I were an entrepreneur in VR era, you'd want to see that your investor has experience in frontier markets. Someone that understands these things take a long time. They don't, they're not just entering into existing e-com or something. So they have some familiarity with that, and they're not too shocked that things change. I mean, things change with all startups. Customers change, revenue mix, everything changes. But having had experience in those frontier markets, and then I suppose, if you're on the enterprise side, connectivity to what might be your early customers, right? So there's often a lot of talk about value add with VCs, and some of it's not real and some of it is real. So just talking to other entrepreneurs who've taken money from those funds, of course, reference checking them and seeing, have they been value add? Do they make a big fuss about it, or do they do it quietly, and sort of sussing that out.
What about, I'm curious stylistically, how involved are you in your portfolio companies? How much do you weigh in? How do you communicate sort of, and I know it can vary, but do you have a specific style you tend to manage? It looks like Mike has some thoughts.
Yeah, so I'm on Slack with most of my portfolio companies. They have a specific channel for the board or for their investors, so I don't need monthly calls or something else like that. I'm just constantly on demand and available. And those are for the companies that actually sit on the board. The ones that I don't, then it's a more kind of episodic kind of engagement. But I think all of us are good on supporting them from a recruitment, since talent is so important. I think we all work on follow-on financings for our portfolio companies because we're in, and then we want to make sure they're successful thereafter. I think 3 of us that are affiliated with corporate programs, we work like the Dickens to kind of evangelize, sell internally on behalf of our portfolio companies. So, I think depending on the class of investor, whether it's an institutional investor or if it's a different type of investor, your expectations as an entrepreneur or management team can vary. Your mileage varies, frankly.
So I just want to prep the audience. In about 5 minutes, we're going to open up to Q&A. So be thinking, getting your questions ready. I have just a couple more for the panel before we do that. So I wanted to bring up the topic of diversity. The venture industry at large has come under a lot of scrutiny, particularly in the last year, for sort of a lack of diversity overall. And there's some really interesting conversations starting there, and some movements and some attention being paid to that area. And so I would love to hear how you all are thinking about that, and if that's an internal conversation that's influencing your strategy or sort of the way you think about investing more broadly.
Yeah, so for us, from a diversity standpoint, we take it very seriously. For last 18 months or so, we have started tracking our not only pipeline and the kind of companies that we've invested in, but also internally how we do hiring for ourselves in terms of investments team. So we have very specific KPIs that we discuss every week in terms of hiring, and also how our portfolio companies are even trying to push that diversity out. Now, of course, now we cannot push them to focus on certain areas, but we like to see in the senior management roles on those startups to have diverse candidates.
I mean, I guess I'll just speak to my experience as a female VC. I started as an analyst at my firm, and a lot of venture funds do have, diversity in the analyst track, but that tends to be a 2-year cycle, and, maybe it inflates the numbers. But in terms of going from analyst to partner, that's very rare. So when you look at female VCs, they tend to have started their own funds. And so I think we're starting to see that change and that awareness, and certainly having, partners that are very supportive. My partners brought me in from day one as an observer on boards, and unless you're learning and you're in the conversations, you're not really going to have the skill sets that you need. So I'm very lucky in that regard. And then now, sort of sitting where I am, on boards and things like that, I definitely have. I've had 2 of my CEOs where I'm on the boards come to me in the last few months saying, I'm panicked. I have no senior female people, or in one of the cases, not a single female employee out of 27 people. How do I deal with this before it escalates? And I think at least them having it in their mind and trying to fill the top of the funnel is a good start. But I think a lot of it is a top of the funnel a problem, and just making sure that they've got the resources and that the rest of the team is welcoming to people from different backgrounds, which usually they are. So that's some of the things that we do think actively about it. We just honestly we don't talk about it that much as a firm, but internally we talk about it and think about it with our companies. That's great.
Yeah, we actually have a dedicated investment vehicle called the Catalyst Fund that purposefully backs diverse entrepreneurs. And then in our VR portfolio, three of our companies are led by diverse management team members. So we're pretty happy about that.
Yeah, same here. I think we've been pretty lucky. Out of our almost 20 investment managers worldwide, around the quarter of the investment managers are women. Marav Wantrab runs our Israel office, Fasha Targi runs our India office, so we have very good leadership at the senior levels as well in each of the regions and throughout Qualcomm Ventures. So I think we've been lucky. I don't know if it's passively, I know we've discussed it quite a bit actually over the past couple of years. And we've had fantastic experiences with it, and we'll look to kind of do more. We're obviously not at parity just yet, only a quarter of the group. But looking to do more.
Do you think that that diversity you have internally is, well, I guess I'm not sure. I know you've been at Qualcomm quite a while, so the point of contrast might be difficult to draw. But do you think that changes your decision-making process versus if you were a more homogenous team? Having those different perspectives at the table, have you noticed that influencing the way you make decisions more broadly?
No, I think we've always been a very flat organization, and everyone's voice is counted. We actually even solicit more of our junior people to come in and talk, and it's just a function of the way we've grown as a small team. When I started 10 years ago, it was only 8 of us. To now we're almost 30 people. So as the team grew, I don't think that flat organization changed much. So we've always had this very collaborative environment, and that I think just encouraged more people to kind of step up and basically take those leadership positions. So I don't think it changed much for us.
Which is very organic. Great. All right, looks like we have some questions rolling in from the audience. So let's see here. I think I saw one pop up before that I was going to ask, and it's not up there anymore. So Rich had talked about KPIs earlier, and you were mentioning that it's very unique. But are there any any metrics you want to mention as things that you look for that they keep shifting. That first question up there, the KPIs that separate business from failing to profitable. So is there anything that comes to mind there specifically?
Out of the KPIs, not so much that separate it from kind of failing to profitability. I think it's more so kind of getting ahead of your shoes. Your expenses aren't matching the. I think your expenses are geared toward your revenue expectations, but your revenue expectations were possibly wrong. So I'm not too sure that there's kind of true KPIs that separate business from failing to reach profitability. I think the one kind of piece of that is making sure your business model and the cost structure are kind of properly in balance. So when you look at KPIs in general, again you hit something generic like daily, monthly active users, whatever your metric is. The corollary to that is, what are the costs of those acquisitions? So not understanding the cost side and the economics of the model more so than kind of any one explicit piece. The customer cost of acquisition usually kills a lot of businesses because they just don't understand what the cost of growing is. So those are the things I'd focus on.
It's a game. KPIs are a game, meaning you guys are going to send us a deck with vanity metrics in it. We know that, right? Everything you show on a chart is going to be up and to the right. So if anything, I will personally discount those slides and try to think, what are the right metrics from your business? And then if I'm interested, I'll say, create that slide for me. Let's actually see what that data looks like, because the ones that look pretty are not necessarily the ones that really tell the true story on the business. So I think don't kid yourself. I know you'll get a lot of advice to kind of create these pretty decks with these kind of nice slides and all that kind of stuff. But I think actually having a truthful conversation with an investor like, hey, we only have 3 months of data. This is what it looks like. It's kind of all over the place, but it's kind of trending this way. This is interesting, but it's really the second kind of iteration or KPI that is going to tell us something. We're too early to kind of really know. I'd rather have a conversation that way, because then I understand how you think about the business, and the data will tell what it is, but at least I have confidence that you as a manager and executive kind of get how, if you had capital, you would run the business.
Yeah, so much of that is really about understanding the thought process. And that was something when I was raising money for my first company, I didn't really understand. I had a lot of frustration as an entrepreneur. Oh, why do I have to go through these exercises that, we don't really know this early what's going to happen? And it was a great investor that sat me down and told me exactly that. It's, we need to understand how you think and how you're contextualizing this data. So it's so essential. A couple of interesting questions from Derek here. So one's about timing, and he's asking specifically, going from a seed round to A round, what's the right time to start thinking about that? I think along with that, we can maybe talk about some metrics as well. And then his second question there is, do accelerators make sense for us? So maybe we can separate those out and start with the timing piece. So seed to A, what would you say in terms of timing and some of the things we should be thinking about in making that leap into an A round?
I mean, I think the nomenclature of these things is always shifting around, right? Like some people do 4 million seeds, and
plus.
Some people do like 3 million A's. So it's all a bit sort of fudging how you want to tell your story, and we understand that. But of course, make sure you've got enough runway when you start that conversation. It always takes longer than you think, and then run a condensed process for your fundraise. Don't have it drag out over, 6 months. Try and get it done in a certain time frame that you decide, and make sure you've got the runway there. I think that also, there will be a natural point to our discussion around KPIs, metrics, where you see an inflection point in the business where you can say, well, we're raising this money to pursue this because we've identified this, product market fit, or we have this MVP ready. And so I think that obviously as a CEO, you should naturally know where that inflection point is, and it's not just panic, we're running out of money. Hopefully there's some line up with the progress in your business as well. And then, accelerators, it sort of depends what's on offer and what the package on the table is there. But I'd say they do make sense generally before Series A. But if there's something that a specific value, maybe it's an enterprise accelerator where you're going to get some access to something, then you could consider doing it later.
The natural motion to go to Series A has always been pulled from the investors. So investors actually tell you that maybe you're at a point with the cash that you have in the bank and everything, that we are interested in investing in you. That's probably the most optimistic scenario. That doesn't happen most of the time, especially in the areas that we are looking into AR and VR right now. So my general advice for Series A has been that you have to look for the right moments in your technology and product development. And if you can justify that raise, that you will need that X million dollars to do this product development, and this is the new category of things that you found, if you're doing a pivot. Or if you're doing like, hey, we were doing this thing and we are running out of cash now, but we are on the right track, and we have these proof points for that. I think there are ways to actually explain it to your current investors and the new investors that you're going to be talking to. But don't try to overthink it, because as Alice mentioned before, investors will see through it. So I think be honest to yourself where you are in the process and what kind of pull you are getting from investors.
So this next question is pretty interesting. What markets are underrepresented? So where do you see the opportunities? And this gets us to I wanted to make sure we got to discuss some trends you're seeing more broadly too. So where are the areas you think there's opportunity for more XR activity? Or conversely, where are you seeing really strong startups? Which sectors, which spaces? You've stumped the panel. Well, I can kick off with one place I've been pretty excited about overall is just healthcare. There's some really, really incredible stuff happening in healthcare, and I think, pace of change and adoption can be slower, but I think the long-term opportunities, not just for, I think there's real opportunity for return, but also obviously the impact some of that can have in changing people's lives, and the therapeutic applications as well as training is something I've gotten pretty excited about. So that's one where there's already some I'm very excited about. I'd love to see more. Mm-hmm.
I think education is another area that I think is very underrepresented. I think something interesting happens with AR and VR in terms of how you think of the spatial information. And I think that creates a memory that is quite interesting from education standpoint. So how people could learn about science, math, or history or geography could be really interesting if you look at it from education standpoint. But I don't think I see many companies in that space.
Do you have any advice for companies looking to break through there? I know education can be a tough market.
Yeah. I think the go-to-market aspect is very, very hard, and that's where I see a lot of the trouble in the education space. It's not about the technology or can you actually build an interesting product. It's actually how to go to schools and municipalities and try to go into that market to actually sell it. And that's where a lot of the challenges come out in that.
So I'd comment on that question the following way, which is, it feels like, again, it's a horizontal look, meaning tell me a market where I should go because there's either more opportunity or less competition, et cetera. A bunch of us also do traditional enterprise tech investing outside of VR, AR, right? When we look there, we're not hypothesizing what market it could be applicable the tech could be applicable in. It's like, hey, we make a software, an oil and gas company bought it, and guess what? When Exxon bought it, then Chevron bought it, and then BP bought it, and then boom, you've got like 30% of the market on your way to 60% to 100% in that vertical. And for us, it's completely believable that you could run the tables. And you might know there's 2 or 3 other players in that in that space. Using your healthcare thing, fine, okay, so tell me what health system you've got. Where's the next health system? In a health system, how do you go from one hospital or one department or one set of beds to another one in the whole 9 yards, right? Like, it's land and expand and constantly. It's not like I'm in healthcare one day, I'm in education the next day, I'm in the third one.
Right.
Like, if that's the case, that's really tough, right? Yeah. Because again, for us, the benchmark is, fine, it's B2B, it's enterprise, but I could do that with a different piece of software and tech and something outside of VR, AR. I don't have to do it in VR, AR. So if it is VR, AR, why is that accelerating from a go-to-market and attraction and a customer kind of pull receptivity that Rich mentioned? So that's how I would kind of think. And that's where I'm still saying, why hasn't enterprise taken off? Why can't we articulate the SAP, the Oracle, the whatever you want to call it on that side in VR or AR? It's just not out there yet. And I think that's where I'm looking for more, and I'm also kind of feeling like slightly disappointed that, this many years into either VR or AR, we haven't really seen that escape velocity on the enterprise side.
Yeah, I would just piggyback on that and say I agree. I mean, it's been a lot of sort of, we're the back-end SAP type stuff, or we're pulling in legacy data, in from an ERP, and it's not so much. I think what's exciting is authoring capabilities, right? And we're starting to see some companies doing this. We're going to capture what's going on and create a database that's our moat, right? So that we've got annotations and a point cloud that can be transferred when new engineers come in, and that's the sort of IP there. And so I think there's some companies starting to do that, but yes, they're working across many different verticals. And so I think a narrow focus is great if you can do that. Instead of just going to aerospace, and we're going to Lockheed, we're going to P&G, we're going to so many different things, and customers that speak so many different languages. And so to your question about what do we look for, I think solving a real world problem immediately, rather than just sort of going to different customers and saying, well, maybe you could do this or that, starting with something where you can really measure the problem and see why AR is so helpful, or it could be VR, in solving it, is important.
Yeah, and domain expertise can be such a huge component of that too. Some of the best solutions I'm seeing are people coming out of an industry, they know forwards and backwards, and solving the problems they see. But the technology is sort of secondary to that, as the best vehicle for that solution. So I think this is our cue, this next question. Are we going to the pool party? I think that's our cue to wrap things up. And sure enough, we have,
the pool party,
yeah,
so
we are running out, or we have just run out of time. So quick poll, who is going to the pool party? Anyone stopping by? All right, got a couple takers. So maybe we'll see you over at the pool party. Thank you all for sticking with us late in the day and for your great questions. Hope to see you around the next couple of days. Thanks.